It just happened. Bitcoin has crashed to $70,000, a level we haven't seen since November 2024. Every gain from the post-election rally has been erased. The 72K support that held for weeks didn't just crack, it shattered. While influencers are screaming, "Buy the dip," liquidation data shows $3 billion in leveraged longs sitting on a knife's edge. One more move down, and we could see a cascade that takes us to 65K, possibly 50K. What you're watching isn't just another 10% pullback. This is the moment where the entire narrative structure of the 2024-2025 bull run is being stress tested, and it's failing. In the next 18 minutes, I'm going to show you exactly what's happening beneath the surface using real liquidation data, institutional flow analytics, and on-chain metrics that most people aren't paying attention to. Quick montage, real exchange data, whale wallet movements, Fed statements. I'll break down the 3 critical price zones that will determine whether this is a healthy correction or the beginning of a multi-month bear market. I'll show you what Michael Saylor and MicroStrategy are facing right now with their 65K cost basis. And I'll explain why the Federal Reserve's hawkish pivot, something almost nobody saw coming, is draining liquidity from risk assets faster than any policy shift since 2022. The death of the election floor. For 15 months, there's been one dominant narrative in crypto: the election floor. The theory was simple. Bitcoin would never fall below the price it hit when Donald Trump won the 2024 election. That level was approximately $75,000, and it was supposed to represent a new paradigm: institutional adoption, strategic reserves, regulatory clarity, the whole package. That floor just got demolished. Bitcoin is now trading at $70,000, which means we're officially below every major support level established during the post-election rally. This isn't a minor breach. This is a complete invalidation of the thesis that drove billions of dollars into this market. Let me put this in perspective. If you bought Bitcoin at any point between November 6, 2024 and January 15, 2026, you are now underwater. That's 14 months of accumulation, 14 months of dollar cost averaging, 14 months of hodling, all erased in a matter of weeks. Here's what happened. November 2024, Trump wins. Bitcoin surges on promises of pro-crypto policy. December 2024 through March 2025, we see record ETF inflows, institutions stacking, MicroStrategy doing billion-dollar buys. April to August 2025, consolidation phase, but the narrative holds. September 2025 to January 2026, another leg up on expectations of the strategic Bitcoin reserve announcement. But then the macro environment shifted. Kevin Warsh, Trump's nominee for Federal Reserve Chairman, began signaling a hawkish monetary policy stance in his confirmation hearings. And this is critical to understand. This isn't just about interest rates. This is about liquidity. Bitcoin is a liquidity-driven asset. When central banks expand their balance sheets, when money is cheap, when investors have excess capital to deploy into risk assets, Bitcoin thrives. But when the Fed pivots to tightening, when they signal higher rates for longer, when they start talking about quantitative tightening, risk assets get crushed. And Bitcoin, despite the store of value narrative, is still primarily a risk asset in the eyes of institutional allocators. Look at this correlation data. In 2018, when the Fed was tightening, Bitcoin went from $20,000 to $3,000. In 2022, when they started raising rates aggressively to combat inflation, Bitcoin went from $69,000 to $15,000. We're seeing the same pattern develop right now, except this time it's happening against a backdrop of elevated expectations that are now being crushed. Graphic. Western institutional sentiment shift. The Western institutional narrative has completely flipped. 3 months ago it was Bitcoin is going to $150,000. Last month it was we're consolidating before the next leg up. This week it's maybe we need to reassess our crypto allocation. That's not bearish sentiment, that's narrative destruction in real time. And here's the thing that should concern you most. This isn't happening because of some black swan event. There's no exchange collapse, no regulatory crackdown, no hack. This is just the market repricing based on macro reality, which means it could have a lot further to go. It's the $70,000 liquidation waterfall. Now let's talk about the immediate technical situation, because what happens in the next 12 to 24 hours could determine whether we get a bounce or a complete capitulation event. This is a liquidation heat map from aggregated exchange data. What you're looking at are clusters of leveraged positions across all major exchanges: Binance, Bybit, OKX, Deribit. The bright zones represent areas where there's massive concentration of leveraged longs. Right here at $70,000 and just below, we have approximately $3 billion in leveraged long positions. These are traders who have borrowed money to amplify their bets that Bitcoin will go higher, and they're all sitting at the same price level, which creates an extremely dangerous dynamic. Let me explain the mechanics. When you trade with leverage, you're required to maintain a certain amount of collateral. If the price moves against you beyond a certain threshold, your position gets automatically liquidated, forcibly closed by the exchange to prevent you from losing more than your initial margin. This isn't optional. It happens automatically via algorithm. Here's where it gets dangerous. If Bitcoin breaks below $70,000 and stays there for an hourly candle close, it triggers liquidations. Those liquidations create sell pressure, which pushes the price down further, which triggers more liquidations at slightly lower levels, which creates more sell pressure. This is called a liquidation cascade, and it can happen incredibly fast. March 12, 2020, Bitcoin dropped from $7,900 to $3,800 in less than 24 hours. The primary driver was cascading liquidations totaling over $1 billion. May 19, 2021. $10 billion in liquidations in a single day as Bitcoin dropped from $43,000 to $30,000. November 9, 2022, FTX collapse triggers $600 million in liquidations. Bitcoin goes from $21,000 to $15,500 in 48 hours. We're looking at potentially $3 billion in liquidations if 70K breaks. That's more than most of the historical events I just showed you. And here's what makes it worse. Look at the order book depth. Between $70,000 and $68,000, there's only about $180 million in total buy-side liquidity across major spot exchanges. On the derivatives side, it's even thinner. If $3 billion in forced selling hits this order book, we're going to slice through these levels like they don't exist. The next meaningful support is at $65,000, which coincidentally is MicroStrategy's average cost basis. We'll get to that in a minute. Below that, $60,000 is the psychological level. And if panic really sets in, $55,000 is where we have significant historical support from mid-2024. Here's what you need to understand. These liquidations are not discretionary. When they happen, there's no human making a decision to sell. It's pure algorithm. Market makers can't step in front of it. Exchanges can't pause it. It just executes until every over-leveraged position is closed. And look at the funding rates right now. On most exchanges, funding is still positive, meaning longs are still paying shorts. That tells us there's still too much leverage in the system on the long side. When funding flips deeply negative and stays there, that's when you know the leverage has been flushed. We're not there yet. So the question isn't whether liquidations will happen. The question is whether 70K holds or breaks. And based on the momentum, the macro backdrop, and the technical structure, the odds are not looking good for the bulls. Institutional exit liquidity, the MicroStrategy problem. Now we need to talk about what the big players are actually doing, because there's a massive disconnect between what's being said publicly and what's happening in the capital flows. While Bitcoin has collapsed 25% from its recent highs, gold has surged to $5,000 per ounce, making new all-time highs. Think about what that divergence tells you about risk sentiment. In genuine flight to safety scenarios, capital flows into actual safe havens. Gold is proving itself. Bitcoin is not. According to prime brokerage data and institutional custody reports, we're seeing significant net outflows from Bitcoin investment vehicles. I'm talking about hedge funds, family offices, and institutional allocators. These aren't retail panic sellers. These are sophisticated entities with risk management frameworks, and they're reducing exposure. Look at the US Bitcoin spot ETF flows. After months of consistent inflows that drove billions into the market, we've seen 3 consecutive weeks of net outflows. That's institutional money leaving. And it's not rotating into other crypto, it's leaving the asset class entirely. This is textbook exit liquidity. The institutions accumulated Bitcoin between $20,000 and $45,000 in 2023 and early 2024. They rode the ETF narrative through 2024 and 2025. Now they're distributing to retail investors who are being told this is a generational buying opportunity by influencers who have affiliate links and referral codes. But here's where this gets truly concerning, and it's something almost nobody is talking about properly: the MicroStrategy situation. Michael Saylor's MicroStrategy has positioned itself as the corporate proxy for Bitcoin. They currently hold approximately 214,000 Bitcoin with an average purchase price around $65,000 per coin. At current prices of $70,000, they're about 7.7% in profit on their total holdings. Not bad, but not the moon either. But here's the critical point. $65,000 is not just a number. It's a psychological and financial threshold. If Bitcoin breaks below that level, MicroStrategy's entire position goes underwater. And unlike a private company that can just hold through volatility, MSTR is a publicly traded company with shareholders, debt obligations, and market expectations. MicroStrategy has issued billions in convertible notes to fund these Bitcoin purchases. Convertible notes are debt instruments that can be converted into equity under certain conditions, but they still have obligations. If Bitcoin significantly underperforms and the stock price collapses, several problems emerge. First, shareholder pressure. MSTR stock is down significantly from its 2025 highs, and it trades at a premium to the underlying Bitcoin value based purely on the narrative that Saylor is a genius. If that narrative cracks, the stock could crater faster than Bitcoin itself. Second, debt covenant concerns. While MicroStrategy's notes don't have traditional margin call provisions, persistent underperformance could trigger refinancing challenges when debt matures. Lenders get nervous when collateral value erodes. Third, the psychological impact. MicroStrategy has been held up as the model for corporate Bitcoin adoption. If they experience significant distress, it sends a chilling message to every other company considering a Bitcoin treasury strategy. And here's what's interesting. MSTR stock has been trading with even higher volatility than Bitcoin itself. During this recent drop, MSTR has fallen harder on a percentage basis than the underlying Bitcoin holdings would justify. The market is pricing in elevated risk. MicroStrategy isn't alone. There are multiple publicly traded Bitcoin mining companies, crypto-adjacent firms, and smaller corporate holders that are similarly exposed. If we get a true capitulation event, if Bitcoin drops to $55,000 or $50,000, some of these entities will face existential pressure. Bitcoin miners, for instance, have operational costs. They need Bitcoin to stay above certain price levels to remain profitable. If it doesn't, they're forced to sell Bitcoin to cover expenses, which creates more sell pressure. It's a vicious cycle. This is why calling this a simple dip is intellectually dishonest. What we're witnessing is a structural repricing of Bitcoin as an institutional asset. The narrative that drove adoption, that Bitcoin is digital gold, a safe haven, a hedge against monetary debasement, is being tested against the reality that it behaves like a leveraged tech stock when macro conditions tighten. And that reality is forcing institutions to recalibrate. Not next quarter, not next year, right now. The bear market trap. Psychology and patterns. Let's talk about the psychological trap that's being constructed right now, because understanding this could be the difference between preserving capital and getting completely wrecked over the next few months. Every bear market, and I mean every single one, is characterized by vicious counter-trend rallies that make you think the bottom is in. These aren't minor bounces. I'm talking about 20%, 30%, sometimes even 40% moves higher that last weeks, even months, before rolling over again. 2018. After the initial drop from $20,000 to $6,000, Bitcoin rallied back to $10,000 in April. Everyone thought the bear market was over. Then it collapsed to $3,000 by December. That rally trapped thousands of traders who bought the dip. 2022, Bitcoin dropped from $69,000 to $33,000, then rallied back to $48,000 in March. Major analysts called the bottom. Then we dropped to $17,500 by June, rallied again to $25,000, and finally bottomed at $15,500 in November after FTX. Multiple traps over the course of a year. Right now, we're in the early innings of what could be a similar pattern. Bitcoin has dropped to $70,000, and you're already seeing the narrative shift. Social media is flooded with buy the dip content. Influencers are posting screenshots of their buys. The hopium is flowing. But look at the crypto fear and greed index. It's currently sitting around 45, neutral territory. We're not in extreme fear. We haven't seen capitulation. And that's a problem, because real bear market bottoms don't form until we see absolute terror. December 2018, fear and greed index hit 10, stayed in single digits for weeks. March 2020, dropped to 8 during the COVID crash. November 2022, plunged to 18 after FTX and stayed below 25 for a month. That's what capitulation looks like, when people are genuinely afraid to even talk about crypto, when CNBC stops covering it, when your group chats go silent. We're not there yet, not even close, which tells me we probably have more pain ahead before this is over. The on-chain data supports this thesis. Exchange inflows are up 40% over the past 2 weeks. That means Bitcoin is moving from private wallets onto exchanges where it can be sold, not into cold storage, not into self-custody, onto exchanges. This is distribution, not accumulation. When we analyze large wallet addresses, whales holding over 1,000 BTC, we see net distribution over the past 14 days. These addresses have reduced their holdings by approximately 2.3%. That might not sound like much, but when you're talking about billions of dollars, it's significant. Smart money is lightening up. Bitcoin miner reserves are also declining. Miners are traditionally long-term holders, but when profitability gets squeezed, they have to sell to cover operational costs. Miner selling pressure has increased 15% month over month. That's fresh supply hitting the market. So here's how the trap works. Price drops sharply, creating fear. Then it bounces 10 to 15%, triggering relief and FOMO. Retail piles in, thinking they're buying the dip. Institutions use that bounce to exit remaining positions. Then price rolls over again, dropping to new lows, and the cycle repeats until all the leverage and weak hands are flushed from the system. We're still seeing elevated leverage in the system. Open interest on derivatives exchanges is down from the peak, but still historically high. Funding rates are positive. Long-short ratios show too many people are still positioned for upside. All of this needs to be cleared before a sustainable bottom can form. The market is setting a trap. The question is, will you fall for it, or will you wait for genuine capitulation signals before deploying significant capital? What to watch? The next 48 hours. All right, if you've made it this far, you're probably wondering, what do I actually do with this information? How do I navigate the next few days without making catastrophic mistakes? Here are the 3 critical price levels you need to watch and what each one tells us about market structure. Level 1, $70,000. This is the immediate battleground. If Bitcoin closes an hourly candle below 70K and confirms with multiple candles, it triggers the liquidation cascade we discussed. Watch for volume spikes and rapid price movement. If this breaks decisively, we're heading to level 2 within hours, not days. Level 2, $65,000. This is MicroStrategy's cost basis and a critical psychological level. If we reach this level, expect significant headlines, mainstream media coverage, and increased institutional nervousness. This is also where we'll see if there's genuine buying support or if it's just another brief pause before more downside. A breakdown below 65K would be a massive red flag for the entire 2024-2025 bull thesis. Level 3, $55,000, $60,000. This is the zone where previous major support exists from mid-2024. If we reach this area, we're talking about a 35 to 40% drawdown from recent highs. Historically, that's bear market territory. This is also where you'd expect to see genuine capitulation, extreme fear, massive liquidations, complete narrative destruction. If we get here, that's when you want to start paying attention to accumulation signals. Here's what to monitor over the next 48 hours. 1. Liquidation data. Track whether those $3 billion in longs get wiped out. Sites like CoinGlass and exchanges' own liquidation trackers will show this in real time. 2. Exchange inflows. If we see another surge in coins moving to exchanges, it confirms continued distribution. You want to see this metric decline before considering any bottom. 3. Funding rates. Watch for funding to flip deeply negative and stay there. That indicates shorts are dominating and longs have been flushed. 4. Fear and greed index. We need to see this drop below 20 and stay there for genuine capitulation. 5. Institutional statements. Pay attention to any announcements from MicroStrategy, major ETF providers, or corporate holders. Silence is actually bullish. Defensive statements or strategic shifts are bearish. Here's my personal approach, and this is not financial advice, just transparency about how I'm thinking about this. I'm not catching falling knives. I'm not buying dips until I see genuine capitulation signals. I'm watching for the market to prove itself, rather than hoping it bounces. If you're already in positions, have stop losses defined. Don't add to losing trades, hoping for a bounce. Accept that this could get worse before it gets better. Preserve capital for when real opportunity presents itself. If you're in cash, don't let FOMO drive decisions. Wait for confirmation of a bottom, not prediction of one. Better to miss the first 20% of a recovery than catch the last 30% of a decline. Use limit orders at key levels rather than market orders in volatile conditions.